Booyah! Let me tell you something. We are living in an unprecedented moment for the American investor, a real barn burner of a market. Right now, as of late 2024, American households have a staggering amount of their financial assets tied up in the stock market. We're talking well over $40 trillion. That's trillion with a T. Think about that number. It's bigger than the entire economy of many countries combined. This isn't just your grandfather's blue-chip portfolio anymore. This is a seismic shift, a fundamental rewiring of how everyday folks are building their wealth. The sheer volume of capital flowing into equities is something we've never seen before. It's a tidal wave of money that has lifted all boats, biggest tech giants, scrappy up-and-comers. Look back just a decade or two ago, and the picture was completely different. In the early 2000s, after the dot-com bubble burst, people were scared. They ran for the hills, stuffing their money into savings accounts that paid next to nothing. Bonds. The percentage of household assets in stocks was significantly lower. Now, fast forward to today, that fear has been replaced by an insatiable appetite for growth. The numbers don't lie. We've seen the proportion of household financial assets invested in equities climb from around 40% to well over 50% today. So you have to ask yourself, what's the catalyst? What's lighting the fuse on this powder keg of retail investing? The answer is simple. Technology, baby. The smartphone in your pocket has become the most powerful trading desk in the world. Think about it. A generation ago, if you wanted to buy a stock, you had to call a broker. A guy in a suit who probably charged you $100 just to pick up the phone. It was slow, it was expensive, and it was intimidating. It was a club, and most people weren't invited. That old world is dead and buried, and good riddance. We're in the age of democratization. Now, with just a few taps on an app, you can buy a piece of the greatest companies on earth for zero commission. Zero. Robinhood, Fidelity, Schwab. They've made investing accessible, easy to understand, and dare I say it, fun. They've gamified it with sleek interfaces and confetti animations when you make a trade. This has brought a whole new generation, millennials and Gen Z, into the fold. These are folks who grew up with technology and expect everything to be instantaneous and user-friendly. The psychological shift among investors has been nothing short of breathtaking. The ghost of 2008, that soul-crushing collapse, wiped out trillions in wealth and scared a generation away from stocks. But it's starting to fade from the collective memory. For years the mantra was risk off. People prioritized capital preservation and left money in low-interest savings accounts. That fear acted like a giant anchor on the market, but that anchor has been pulled up. Today the dominant emotion is FOMO. FOMO is the jet fuel of this bull market. Younger investors see the market as a wealth creation machine. Explosive gains in tech stocks, viral stories of meme stock riches, an urgent need to participate, not worried about losing 20%, worried about missing a 100% gain. A full reversal, defensive to aggressively forward-leaning. Now we have to talk about the other side of the coin. This massive influx of money into the market is a classic double-edged sword. On one hand, it's fantastic. It provides capital for companies to innovate. It provides capital for companies to expand. It provides capital for companies to hire more workers. It powers the engine of our economy. When people feel their net worth increasing every month, they have the confidence to go out and spend. That spending boosts car sales. That spending boosts restaurant reservations. This wealth effect is real. A major tailwind for the US economy. But here's the frightening part. The part that keeps me up at night. What happens when the music stops? It means the fate of the average American household is more closely tied to the performance of the S&P 500 and the NASDAQ than ever before. When the market goes on a tear, household wealth skyrockets. People feel richer, they spend more. And the whole economy gets a nice juicy boost. This creates a powerful feedback loop. A rising market brings in more investors, which pushes the market even higher. It's a beautiful thing to watch when it's working. A real symphony of capitalism. But, and there's always a but, it also means the stakes have never been higher for millions of people counting on this bull to keep running. Markets do not go up in a straight line forever. It's a stone-cold fact. There will be corrections. There will be bear markets. With so many households exposed to stocks, the potential for widespread financial pain is enormous. A downturn would not just be a headline on CNBC, it would hit retirement savings, it would hit college funds, it would hit home down payments. The same wealth effect that feels so good going up can become a devastating poverty effect going down. This is why I'm always screaming about homework. ease of access can breed complacency. Buying a stock in 10 seconds doesn't mean you should. Many new investors pile into the hottest names without understanding the underlying business. They don't grasp valuation. They ignore the competitive landscape. They're chasing momentum, not value. They're buying the story, not the fundamentals. That speculative behavior can create massive bubbles. When bubbles pop, and they always do, the last buyers get hurt the most. It's a tale as old as time. So here's the bottom line: more Americans participating in wealth creation is fantastic. It's a positive, long-term trend. But increased participation brings increased responsibility and risk. Popularity is confidence, and a vulnerability. My advice: stay in the game. You can't win if you don't play, but be smart about it. Do your homework. Diversify your holdings. Never invest money you can't afford to lose. There's always a bull market somewhere. There are always bears lurking in the woods. Don't get mauled.